If you and your spouse earned $100,000 last year, you know exactly how much pain you felt paying federal and state taxes. But what if I told you there is another invisible tax that is quietly taking the rest of your wealth? And it doesn't even show up on your pay stub? Have you noticed how your grocery bill has exploded but your paycheck hasn't? This isn't a supply chain accident. It is a deliberate mathematical phenomenon known as financial repression. And the government relies on your ignorance to make it work. Let's pull back the curtain on how the system actually operates and how you can protect yourself. Let's translate that into plain English. You are working in a system where the scoreboard is rigged. You think you're measuring wealth in dollars, but dollars are the very thing being diluted. So you can be more disciplined than ever, work harder than ever, budget tighter than ever, and still feel poorer every single year. That is not because you suddenly became irresponsible. It is because you are trying to climb a staircase that is moving down. And the reason that staircase keeps moving down comes back to one ugly number: government debt. When a nation's debt load gets absurd relative to the size of its economy, the options get brutally simple. A government can grow its way out. It can tax its way out. It can slash spending and run austerity. It can default outright, or it can inflate the debt away. That's it. Those are the doors. And once debt to GDP gets beyond the danger zone, once it pushes past levels like 120%, and the promises piled on top of that debt are even bigger than what's on the official balance sheet, three of those doors start slamming shut. Growth alone won't save you if debt is compounding faster than the economy. Taxing your way out sounds tough and noble until you realize there's not enough political courage on this planet to squeeze enough revenue out of the population without detonating the economy first. Hard austerity is political suicide because voters love spending until someone tells them the bill is due. And outright default? For a government sitting on top of a giant banking system, pension system, bond market, and welfare state, that is the nuclear option. So what do they choose? They choose the stealth default. They choose inflation. Here's the math. Imagine a country with debt equal to 120% of GDP. If nominal GDP is 100 and debt is 120, that's your starting point. Now imagine real growth is weak, say 1 or 2%, but inflation pushes nominal GDP higher by 5, 6, 7, maybe more. If interest rates paid to savers and bondholders are kept artificially low while inflation runs hot, the government is paying back old debt with cheaper currency while the denominator, GDP measured in nominal dollars, rises. The debt burden looks more manageable not because the government got disciplined, but because the currency got uglier. They didn't solve the problem, they redefined it in weaker units. And that is financial repression. Financial repression is the polite academic phrase for a very nasty transfer of wealth. It means the government and central bank structure the system so that your savings earn less than the true rate at which your purchasing power is falling. They hold interest rates down. They encourage or pressure financial institutions to hold government debt. They regulate the system so your safe options are mostly traps. They let inflation run above deposit rates and often above bond yields. They quietly punish the saver to rescue the debtor. And who is the biggest debtor in the room? The government. Always. So when people say inflation is just prices going up, that's incomplete. Inflation is not merely your eggs getting expensive. Inflation is a transfer. It is a stealth tax. It is wealth being siphoned from people who hold currency and fixed claims on currency and handed to those who owe large nominal debts. If you save in dollars and the dollar is being diluted, you are funding the system. You are the donor. You are paying a tax you never voted on and rarely see itemized. This is why the old advice about putting your money in a basic bank account and feeling virtuous is dangerously outdated. I'm not talking about emergency cash. Everybody needs liquidity for bills, repairs, job loss, life. I'm talking about long-term wealth. If your long-term strategy is parking your life force in an account, paying basically nothing, while the money supply keeps expanding and prices grind higher, that is not safety. That is slow-motion financial suicide with a user-friendly app. Let me give you a family you probably know because it might be you. Picture a couple. They do everything right. They both work. Combined income, maybe $100,000. They meal plan, they drive used cars, they skip vacations, they say no to stupid purchases. They keep $40,000, then $60,000, then $80,000 in cash because they think they're being responsible. They were told cash is safe. They were told the stock market is risky, real estate is risky, starting a business is risky, owning hard assets is risky. So they cling to the one thing that feels stable, the number in the bank account. Then life starts squeezing. Groceries that used to cost $180 a week are now $280 or $320. Rent is up, insurance is up, car repairs are up, utilities are up, daycare is up, property taxes are up, healthcare is up. Their bank is paying them some insulting microscopic interest rate, the financial equivalent of being tipped with pocket lint. They open the app and see the balance still there. 80,000 looks safe, looks untouched. But what they don't understand is that the number stayed the same while the purchasing power got mugged in the parking lot. This is the cruel genius of inflation. It does not have to take your dollars. It only has to make your dollars buy less, and compounding makes this far worse than most people realize. People understand compounding when it comes to investing, but they forget compounding also works in reverse against them when it comes to inflation. At 3% inflation, your purchasing power gets cut roughly in half in about 24 years. At 6%, it gets cut in half in about 12 years. At 8%, it's around 9 years. That means if you hide $100,000 in a checking account and inflation averages 6%, in 10 years that money may still say roughly $100,000 on the screen. Maybe a little more with laughable bank interest, but in real buying power, it behaves more like roughly $56,000. Stretch that to 20 years, and you're looking at something closer to $31,000 of today's purchasing power. At 8% inflation, the 20-year picture is catastrophic. That $100,000 becomes the economic equivalent of just over $20,000 in today's dollars. Read that again in your mind. 20 years of discipline can be turned into the spending power of a used economy car. And yet, people still say, at least my money is safe in the bank. Safe from what? Volatility? Maybe. Safe from confiscation through debasement? Absolutely not. Now let's deal with the blind trust in fiat currency because this is one of the biggest mental prisons people live in. Fiat currency is not wealth. It is a claim ticket. It is a tool. It is useful for exchange. It is useful for paying taxes. It is useful for short-term transactions. But long-term, fiat has a built-in political incentive to lose value because the institutions issuing it are structurally rewarded when it loses value. The more indebted the system becomes, the more tempting debasement becomes. You don't need a conspiracy. You need incentives. History screams this at us. Take the Weimar Republic. When the currency went into terminal collapse, the people who got obliterated were the people living on wages, cash savings, and fixed incomes. The people holding paper promises got eviscerated, but debtors with hard assets had a completely different experience. Farmers with land, equipment, inventory, and real productive capacity found themselves in a bizarre position. Their debts were fixed in a currency that was collapsing, while the stuff they owned and produced repriced upward with the inflationary storm. They could sell crops, repay debt in worthless money, and hold on to real assets everybody still needed. I am not glorifying that nightmare. It was social and economic chaos. But the lesson is unforgettable. When the currency dies, ownership matters more than salary, and productive scarcity matters more than paper claims. That same principle showed up in a less theatrical, but still deeply predatory form in the United States during and after the 1940s. The government had massive war debt. How do you keep that debt from crushing the system? You don't necessarily announce some villain speech about robbing savers. You do something subtler. You hold interest rates down, you cap yields, you lean on the financial system, you let inflation run above those yields, you create negative real returns, and suddenly the debt starts getting liquidated, not through honesty, but through the silent destruction of bondholder purchasing power. So imagine being the responsible saver back then, buying government debt or sitting in fixed income instruments because you were told it was prudent. Meanwhile, inflation burst higher, but your yield is pinned low. On paper, you're earning something. In reality, you're going backward. The government's debt burden gets lighter, and your savings get lighter with it. That is financial repression with a patriotic smile. This is why I get so irritated when politicians and central bankers bury this process in jargon. They'll say things like accommodative policy, liquidity support, price stability, temporary overshoot, stimulus transmission. Strip away the silk tie language, and what are they actually doing? They are increasing the quantity of money and credit in the system, suppressing the real return on safe savings, and hoping you are too busy, too distracted, or too financially uneducated to notice that your standard of living is being shaved away a little at a time. And that brings me to the next sacred cow that needs to be dragged into the street. The idea that inflation is mainly the fault of greedy corporations. Look, corporations can absolutely exploit a situation. They can pad margins during chaos. They can use a media narrative as cover. They can behave badly. But if you think broad, persistent inflation across food, housing, energy, healthcare, education, services, labor, and assets is explained simply by corporations got greedy, you are thinking at the kindergarten level of macroeconomics. Were corporations not greedy 5 years earlier? 10 years earlier? Did greed suddenly debut this quarter? Greed is constant. What changes is the quantity of money and credit sloshing through the system, the fiscal deficits, the interest rate policy, and the public's tolerance for being lied to. If you massively expand the money supply and credit creation over time, you get more currency units competing for a limited pool of goods, services, land, labor, and assets. That does not mean every single price rises evenly or instantly. It means the purchasing power of the currency trends downward, and price signals get distorted across the entire economy. Some corporations are passengers taking advantage of the ride. But the engine is the monetary system. This is where M2 matters. M2 is not some magical prophecy tool, and it's not perfect, but it is a useful window into the broad money environment. And over long periods, the direction has been unmistakable. More money units, more bank deposits, more liquidity, more claims on real stuff. You do not need a doctorate to understand what happens when the supply of money expands far faster over time than the supply of truly scarce assets. The money gets less rare. The scarce asset gets more expensive in money terms. That is why holding wealth in paper cash or a basic checking account is such a losing proposition. Cash is not an investment. Cash is a parking spot. Useful for mobility, terrible for long-term storage. If you leave your car in a parking spot for a minute, great. If you try to live there for 20 years, you've lost the plot. So what is the survival playbook? How do you actually build wealth outside this rigged system? You stop worshiping currency and start owning productive, scarce assets. You need to understand something foundational. Inflation does not hurt all people equally. It punishes holders of cash and fixed income claims. It rewards owners of assets that are scarce, useful, and repriced upward as the currency gets diluted. The game is not to predict every inflation print. The game is to position your capital so that when the currency is debased, your balance sheet rises with it instead of getting vaporized by it. Real estate is one of the clearest examples. Why? Because well-located property is finite, shelter is always needed, replacement costs rise with inflation, rents can adjust over time, and if you finance it with long-term fixed-rate debt, inflation can actually work in your favor. Think about the absurd beauty of that setup. You borrow in today's dollars, buy an asset that tends to reprice in tomorrow's cheaper dollars, and pay back the loan with currency that has been diluted. Meanwhile, the property itself and the rental income often rise in nominal terms. That doesn't mean every property is automatically a genius investment. Bad area, bad price, bad leverage, bad management, bad deal structure, you can still get wrecked. But as a category, quality real estate has historically been one of the best shields against currency debasement because it combines scarcity, utility, and the potential for income. Then you have low-cost index funds. This is where people overcomplicate things because they think investing means becoming a day trader or a market prophet. No. A broad low-cost index fund is simply a way to own a slice of productive businesses. And businesses, especially the stronger ones, are not static victims. They can raise prices. They can grow earnings in nominal terms. They can adapt. When the currency unit weakens, the revenues, assets, and profits of real companies often reprice upward over time as well. Again, not in a straight line. There will be crashes. There will be recessions. There will be terrifying drawdowns. That's the admission price for real returns. But over long periods, owning productive enterprise has beaten sitting in cash because businesses are attached to real economic output, not a stagnant pile of depreciating paper. Then there are hard assets, things that are difficult to print, difficult to fake, and anchored to physical scarcity. Think land, certain commodities, energy exposure, precious metals, critical resource assets. These do not always produce cash flow, so I would never tell you to build your entire financial life around non-productive rocks and shiny objects. But as part of a larger defense strategy, hard assets can serve as a pressure release valve when trust in paper claims starts eroding. They are not magic. They are insurance against monetary arrogance. Notice the pattern. Scarce, useful, productive, hard to print. That is the opposite of fiat cash. And here is where your identity needs to change. Stop seeing yourself as a saver first. Start seeing yourself as a capital allocator. Stop asking, where can I hide my money? And start asking, what can I own that the system cannot cheaply dilute? That one mental shift changes everything. The saver mindset is defensive and static. It says, I hope nobody takes what I've stored. The investor mindset is strategic. It says, I know the system devalues idle currency, so I will convert currency into claims on real assets and productive output. That does not mean recklessness. It does not mean putting rent money into speculation. It does not mean chasing memes, leverage, garbage properties, or random trends. It means understanding hierarchy. First, maintain liquidity for emergencies. You do need some cash. Short-term obligations are real. Second, eliminate toxic high-interest debt because compounding against you at 20% is a financial death sentence. Third, consistently move surplus capital into assets that can outrun debasement over long periods. Fourth, automate the process so your emotions don't sabotage you. That's how normal people win. Not by timing every cycle, not by reading 10,000 headlines, by accepting the monetary reality and building a balance sheet designed for it. Let me make this brutally concrete. Person A saves $1,000 a month in a basic account for 20 years. Person B keeps an emergency fund, but invests $1,000 a month into a mix of productive assets. Person A feels safer every month because the account balance rises smoothly. Person B feels nervous sometimes because markets move, properties need maintenance, headlines get ugly, and volatility is emotionally taxing. But 20 years later, Person A has a pile of money that has been chewed up by inflation for 2 decades. Person B owns assets that, despite the chaos, have repriced with nominal growth, inflation, and productivity. One person stored labor in a melting ice cube, the other converted labor into ownership. And this is why the average working family feels like they can never get ahead. They are playing defense in a game built to reward offense. They save in the unit being diluted, then act shocked when they need more units to buy the same life. The ruling class understands this perfectly, by the way. They do not sit around with their serious faces talking about the virtue of holding giant cash balances for 30 years. They own assets. They own real estate. They own businesses. They own equity. They own infrastructure. They own land. They own claims on future cash flow. Then they tell the middle class to be careful and stay safe in cash while the money printer does what it always does. You do not need their permission to stop playing the sucker's role. And I want to be very clear about one thing. You cannot control the central bank. You cannot control deficit spending. You cannot control the debt ceiling theater. You cannot control policy meetings, bond auctions, banking regulations, or the political addiction to spending money that does not exist. But you have 100% control over where you park your own capital. That is power. You can choose whether your surplus labor sits in a checking account, getting silently taxed, or gets converted into assets that fight back. You can choose whether inflation happens to you, or whether you position yourself so inflation works for you. You can choose to be the family holding cash while groceries, rent, and insurance run away from them, or the family steadily accumulating ownership in scarce and productive things. That's the real divide in modern finance. Not rich versus poor, not left versus right, not this party versus that party. It is owners versus holders of currency. It is people who understand debasement versus people who are still waiting for the system to reward passivity. And once you see it, you cannot unsee it. The paycheck alone will not save you. Budgeting alone will not save you. Frugality alone will not save you. Those things matter. They matter a lot. But they are the foundation, not the fortress. If you stop at saving, the fortress never gets built. You need discipline to generate surplus. Then you need courage and intelligence to deploy it. That is how you make money during inflation. Not by hoping prices go back to 2019. Not by screaming at grocery stores. Not by collecting pennies of bank interest while dollars are diluted by the trillions. You make money during inflation by owning what inflation lifts in nominal terms. You make money during inflation by being on the asset side of the ledger, not the cash side. You make money during inflation by understanding that the game is not fair and then building a strategy that doesn't require fairness. You are not helpless. You are not trapped. You are not condemned to watch your purchasing power dissolve year after year while officials tell you it's temporary, technical, or necessary. You can opt out of the victim mindset right now. You can start acting like an owner. You can build a portfolio that benefits from the very thing that is destroying everybody who refuses to adapt. That is the cold, hard truth. You cannot outsave inflation. You must outinvest it. Subscribe to the channel to learn exactly how to build a recession-proof portfolio.